Hi, good morning, everyone. Uh, this is Rashmi Shah here. Um, Thank you for your patience. I'm doing this webinar after quite some time, and I thank especially Mr. Siddharth Shah and Pranjal for requesting me, reminding me that my webinar is overdue now, and with all this global turmoil. Um, so it's a good way to connect with you all, guys, and yeah. So feel free to ask questions. And the other thing which I want to remind before I start today's talk that this webinar is for only for people living in India, not for people living in America or Canada, or where we're not marketing this service. And I'm happy to take any questions, and if any questions are left unanswered at the end of the webinar, feel free to contact us. Okay, thanks. So let's begin. Yeah. So turmoil. There is a turmoil in the developed world today, correct? There is not only in developed world. There is a turmoil in many countries like Pakistan, Sri Lanka. You can take even Bangladesh. Their currencies have depreciated by 100%. Turkey inflation is 100% annual inflation, correct? London, UK, then US, everywhere there is a problem. So where do we go from here? So I'm going to talk about that. The key causes for global global realignments and adjustments happening. Now, if you see, the three forces are playing in the global market. One is digitalization and reforms. There is a massive technology improvement which has happened in the last 10 years. Um, and reforms have taken place in countries like India, where direct and indirect taxes and so many things have happened. Then there's a long-term demographic change is happening. The world is getting older and older. There are more older people living in India today than what was the population of India in 1960. Correct? The people above the age of 50, population of India today is more than what the population of India was in total population in 1950. So a lot of demographic changes are happening. And in the last 3 years, COVID and Russia-Ukraine war are the two major factors which have destabilized the global supply chain and all the markets. So I'm going to talk about that. And there is a pattern of what is happening in the market. There is a pattern which we can see, and I'll share that with you, correct? Now, which markets were affected by this? It has affected all the markets: stock market, debt market, real estate, commodities, crypto, private equity, and derivatives. So everything has got affected. It's like like everybody at the home has fallen sick. The same way, every financial instrument or commodity instrument, everything has got impacted in last 1 year in a good way or bad way, correct? Oil, it has affected in a good way. All other things, it's in a bad way. So what it means, correct? So let's look at the global financial markets from 1 year perspective. So if you see, I've here taken S&P 500, Nasdaq, Nifty, Dow Jones, Nikkei, then Russia, Hong Kong, which represents China. So if you see this, the circles here, correct? The red where I have marked this part. India, most of these countries bottomed out in the month of June, but Russia and China and Nasdaq has still not bottomed out. They have gone below the level of, or even S&P 500 has gone below, except for Nifty and Nikkei, which is still above what the bottom we hit in June. Correct? So the markets have corrected very sharply. The least correction has been on a 1 year basis in Nifty. The Nikkei has corrected by 8%, but Nikkei has corrected. The Japanese yen has corrected by 20%, but this is in local. All these indices are in local currencies. Correct? They are not in dollars. So Nifty has corrected in rupee terms by 2.5%. Nikkei in Japanese yen has corrected by 8%. Now, if you convert this into dollars, then Nifty has corrected more than 12% in dollar terms. Nikkei has corrected more than 38% because the dollar has appreciated, correct? In this, but if you look at the local currencies, this is the correction which has happened in the Russia and Hong Kong, China are the major corrections. The major corrections. So this has happened. Now this is from 1 year perspective. Now let's look at the chart from pre-COVID levels. So if you look at the pre-COVID level in 2020 March, all the then stock markets in the world bottomed out here, correct? And then from there it rallied. So Nifty has the best performing from February 1st, 2020. Remember, the correction started after 15th February 2020. The COVID impact started coming. Nifty has corrected, has gone up by 46%. Nikkei has gone by 17%. And you see here, Russia and China are still minus 36, 37%. So they have gone even below, they have even gone below pre-COVID levels. So these are the two economies which have gone below pre-COVID levels. Now let's look at this same chart, same market from another angle, correct? Last 20 years. If you look at last 20 years, again, Nifty is the best performing market for last 20 years. Now all this market corrected in 2008. Correct? They corrected in 2008. But some of them, now, if you see Hang Seng has gone 85% up in last 20 years. In absolute term, this is not annualized, correct? This is, and let me tell you, this is all in local currencies. Nikkei has gone by 200% up, 217. Russia has gone up by 551%. Nasdaq by 1100%. So even after this sharp correction, it's 1100% up, and Nifty is 1600% up, correct? Very good performance if you look at last 20 years. Now, I'm trying to see the big picture and see what's happening, correct? And I'll explain you what it means to our portfolio and our investment strategy. Now, let's go to the next slide, correct? Between the stocks in last 52 weeks, see Zoom has corrected by 75%. Nvidia, they say there is a chip shortage worldwide, and this is the biggest, most technological advanced semiconductor company in the world. It has given minus 68. Netflix minus 67. Amazon 43. Boeing 43. JP Morgan 36%. Microsoft, Apple, Berkshire, and Walmart. All this stock, you see, they have corrected very sharply, correct? Now, what it means, none of these companies are going to go bankrupt. They will exist. They are going to exist 10 years from today, except for Zoom, and maybe if Zoom may get acquired by someone, it may merge with some of the big players, or Netflix can also get merged with someone. But other than that, all other companies are going to be there even after 10 years, 20 years. These are very good blue chip companies. Now they have corrected very sharply in last 1 year. So I think they are close to the bottom. When anything goes so sharply, they are going to bounce back. But see the other thing which I want to tell you, like we have FFI investing in India. The FFI investment in India at the peak time was 24%. They have sold 5% or 6% in last 1 year. So their holding today is 19% of Indian stock market. You know what is the FFI investments in America? So foreigners investing in America is 40%. So what has happened in America? FFIs means investors from China, investors from Europe, investors from Canada, Australia. They all sold their stocks in US. And in addition to that, the locals were also selling. The local population was also selling. In India, it opposite happened. The FFIs were selling. The Indian population was buying Indian stocks. That's why India didn't correct that much. But in America, both of them were selling. When both of them were selling, the correction was very sharp. Now 40%. Now imagine if Indian people were selling their stocks, the correction would have been very severe in India, like 2008. So you need to keep that in the back of your mind. Why there is a difference between US and India, and why Indian public is not selling. I'll tell you about in later part of this webinar. So you have to see this from that perspective. Now, the other thing which is destabilizing worldwide is the petrol prices. So let's look at the petrol prices worldwide in dollar terms. So we have converted the rupee petrol price into dollars so we can compare everywhere, correct? So the most expensive petrol in the world today is in South Africa. It's $13 per liter. Switzerland is $2.21 per liter. Germany, one. So mostly this is Europe. Singapore also is the same price. In United Kingdom, London, petrol is more expensive than India. In India, the petrol is $1.19 per liter. Correct? In United States, it's $1 per liter. So India, I mean, all these countries, it's fairly priced. And if you see this price, countries below Brazil, Russia, Argentina, they're all oil-producing countries. So there it's cheaper. China is also reasonably priced, like US. India is only 20% higher than China, but we are reasonably priced. Now, what is happening? Petrol in countries like Pakistan, Sri Lanka, Bangladesh, Africa is even more expensive because their currencies have depreciated by 100%. So, what are you going to see? We are going to see in next few years, next 1 or 2 years, all the regimes in those countries are going to get voted out. Local people don't understand that their prime minister or president does not control the petrol price, but they blame them and they will throw those governments out, correct? They don't understand that petrol prices is a global thing, not any country specific. But we are going to see a lot of political instability because of this petrol. And this is one thing which has affected the thing. So we have to look in a very broad perspective. Now let's go to the next. Let's compare gold, oil and stock markets over 1 year. So if you see, the best performing commodity in last 1 year has been oil, 35%, which is no surprise, correct? Then the second best performing is the US dollar. Indian rupee has depreciated by 10%. Nifty has, in local currency, given minus 5% return, correct? So if we add minus 5 and plus 9, so it means 15%. Nifty has given 15% negative returns in dollar terms. This is Dow Jones. Gold has gone down by 23% in dollar terms. Now gold has gone down 23% down in dollar terms, and dollar has appreciated by 10%. So in rupee terms, gold has given minus 13% return. Nasdaq has given minus 25. So you look this from a different perspective, correct? How this is playing out. Now, the reason I'm showing all this, I want to get a very big picture. What is going to happen next, correct? That's the reason why I'm showing this slides. Now, gold, oil, and stock pre-COVID level. So from pre-COVID, 1st February 2020, what has happened? Again, oil is the best performing. Remember, oil in the initial days had gone to $0. Remember, there was so much, the world shut down and there was surplus oil everywhere. So oil price went negative, correct? From there, anything which fell so sharply has gone the highest. So that's the law of physics. Remember this, anything which falls very sharply bounces back. So that's the other thing we have to remember while looking at all these charts. Now, Nifty is the second best performing after oil in local terms. Nasdaq is the third best. Indian rupee is not the perfect, it's a dollar, correct? Dollar is the fourth, and gold is still minus 16% in dollar terms. So if you look at from pre-COVID level, gold has gone down in dollar terms. Correct? Rupee has gone down by 15%. So if we swap rupee and gold in rupee terms has given 0% return because they offset each other, correct? Now let's look at the chart from 20-year perspective. Again, Nifty is the best performing. Nasdaq is still, after 40% correction this year, it's still the second best performing after Nifty. So then comes Dow Jones, and then comes the rupee has depreciated by 70% in last 20 years. So 70% depreciation. Gold has appreciated by 20, and oil has given only 20% appreciation. So oil is still reasonably priced over a period of 20 years. So if you take oil in dollar terms for 20 years, it is appreciated only 1% per annum, which is reasonable, correct? Inflation-wise. If you look at that perspective, oil has appreciated only by 20% in dollar terms for 20 years. So that's 1% per annum, which is nothing alarming, correct? But that's what it is. So now let's go to the next slide. Global currencies. Now we look at the currencies, correct? In last 1 year, you saw this Russian ruble, correct, depreciated the means the dollar against ruble. Dollar made the most gains, but today Russia is the best performing currency on a 1 year basis. Can you believe that? So Russian currency had crashed by 90%, and today it is giving 12% positive returns. So it's rebounded so sharply. Indian rupee has depreciated by 9. China has depreciated by 12%. Euro has depreciated by 19%. Pound has depreciated by 22 and Japanese yen by 31%. The yen has fallen down very sharply. So currency wise, again, rupee is the second best currency after ruble. If you look at this way, that's from 1 year perspective. Now let's look at from pre-COVID again. Again, if you look at pre-COVID, ruble, Russian ruble is the best performing currency. Then China. India has depreciated by 15%. Japanese yen again 36%. So you see that Britain and so this is from pre-COVID level. Now let's look at 20 years again perspective. Global currency wise, ruble has depreciated by 97%. So the Russian currency has depreciated by 97%. So it has depreciated very sharply in 20 years. Rupee has depreciated by 70% in last 20 years. That's the reason I'm saying every Indian should have 20% investments in US. The reason is yeah, the Japanese yen has depreciated by 19, and the Chinese currency is appreciated by 46%. So on a 20 long-term chart, China currency has done better, correct? So this is the way we are looking at it. So nothing alarming. Now, other thing, interest rates. We are talking about interest rates and stock market valuations, correct? So if you see, whenever interest rates have gone up, interest rate cycle is of 40 years. 1940 interest rates. You see this chart here. Red one is the interest rate. The blue is the price earning ratio of the stocks. So when interest rates were lower, price earning ratio was higher. The markets were doing good. So in 1940, interest rates were low, and then for next 40 years, gradually interest rate went up to up, and it was highest in 1981. And from there, for next 40 years, interest rates kept on going down, and now it is reversed, correct? Now it, and the P, you see the P, correct? You see the P. So this chart. So now we are going to see a high interest rate chart. The next 40 year cycle is starting again. Now that is the reason the global markets is adjusting, correct? Just now they are doing the adjustment. Now long-term interest rates for 40-year cycles, if you see, they are all 40-year cycles. In history will tell you. So now we don't expect the interest rates to go back down to what it was last year or year back. So interest rates in India are going to go up. If interest rates don't go up, then rupee is going to depreciate further. Now that is the money flow because US interest rates have gone up. Now I'll show you how much they have gone up. 30-year mortgage rates, correct? The American real estate market is the biggest real estate market in the world, and 60% of Americans buy homes using mortgage. And that mortgage, the most popular mortgage there is a 30-year. Now, 30-year mortgage rate had gone down to less than 3%, and it has gone to 7% now. So it has doubled in last 1 year. Sharp rebound has happened. Now it was highest at 18% in 1980, and from there gradually went. So 30-year mortgage rate is one of the most popular investments in America. All these pension funds, college endowment funds, super rich people, they invest in mortgage bonds 30-year because if it gives 8 or 9% return, it's a very good return, which was giving only 3% return a year back or 4 years. So a lot of money is flowing into this market, and less of people. If mortgage rate go double, my affordability to buy a property goes down by half. So the real estate market also is slowed down in America drastically in last 3-4 months. Now, such a sharp rebound has happened. I think now there will be some correction here. It will stabilize at this level for some time, and then again it will go up. It can't go up in one shot like this. So there will be some correction here now. and you'll see that. So the reason I'm showing from this perspective, the why this is happening, because there is a shift in the economies, global economies, economies of Germany, economies of UK, economies of Japan. They are slowing down, and China, India, they are coming on the world stage. So what happens is, when this kind of destabilization happens on the world stage, the currency market, the commodity market, interest rates, everything gets readjustment, and that's what's happening now. India is lucky today. Why India is not normal course? If Nasdaq corrects by 40%, Indian stock markets correct by 50%. Why that has not happened this time? It has always happened that way in the past, but this is the first time it has not happened, because we have a very strong political leadership, and the best reforms any country could have done was GST. GST, direct and indirect taxes, those two reforms happened in last 10 years, and that major structural reform is helping India formalization of the economy. So the black economy is shrinking, and money is flowing into more in the corporate world, and the corporate balance sheets are becoming good. Government balance sheet is becoming good, and that's what has saved India. If we hadn't done GST and digitalization in last 5 years, Indian rupee would have been 150. Dollar would have been 150 today, like Pakistan or Sri Lanka or Nepal or Bangladesh, all those currencies. So we are lucky we did those reforms in last 10 years. The reforms are very painful, but that was very good necessary. That was because of that, and still we have yet to see the benefits of the long-term benefit of GST, which will be there for next 10 years. Which is That's what I'm saying. The impact of the strong macros due to structural reforms in direct and indirect taxes has happened. It has helped the current Indian currency manage well. Then long-term FDI investments are coming, because global supply chains want to adjust and rebalance, and India is opening up. Indian policies has changed, and that's why a lot of large investments are coming, like in telecommunication, in retail. Like IKEA opens one new store, they have to bring in $1 billion. If opens 10 stores, they have to build $10 billion. Correct? That kind of large investments are coming in India. Industrialization is happening now. If today still India, the supply chain cost is 24%. 24%, because there is a lot of wastages, and it takes 3 4 days to ship a product from interior India to the ports, correct? And there is a lot of leakages. Now, if the highway infrastructure is built and we are able to ship the products very efficiently, and supply chain cost comes down, India is going to be very competitive, correct? And that is going to help industrialization. So that reform is helping, and GST and demonetization and indirect taxes, that's all helping formalization of the economies. So our top 200 companies are going to be the biggest beneficiaries of that. And because of these structural reforms, India didn't get hit in this global turmoil. India is one of the few countries. Now, we shouldn't brag on it that India is the best. No, we are way behind the world still. If you look at a long-term basis, and India still has a lot of poverty. India has still a lot of things has to happen here. If this momentum has to continue, but we are on the right track. That's a good thing. And what also it tells us that whenever markets correct so sharply, it's the best time to invest. Now I'll show you another thing. If you compare India and UK here, so if you compare India and UK, the GDPs of both the same size, $3.2 trillion. The growth rate in India is 8.3, UK is 7.7. Indian currency depreciated by 10%, UK depreciated by 18. Forex reserve, we have 535 billion, they have 180 billion. Our debt ratio is 74, there is 96. Our fiscal deficit to GDP is 9%, there is 14. But India, if it has to borrow money in the international market, India gets loan at 7%, UK still gets at 4%. In spite of UK's balance sheet being bad, India's balance sheet being good, still we are getting higher interest rates, because our credit rating for long term has not improved. Our credit rating, so okay, we had very good last 10 years political reforms, but we have to continue this for another 10, 20 years. Then our ratings will improve. Once the ratings improve, we will be able to get loans from international market much cheaper. So there is a long way to go. Uh, the law enforcement of law, judicial systems, all that has to, the civic sense, all that has to improve. If you look at, compared to India and UK is better than India in enforcement of law. UK is better than India in civic sense, correct? And that's why overall, if you see, they get a better credit score than India, the track record. The same way, for India to go to the next level, we have to slowly keep moving in that direction. So we should not brag that India is the best. India, West is suffering and India is doing good. We have to be realistic, understand why this is happening, and continue working on it. And also, we should use this opportunity to invest. When the West people they'll make mistake once, they'll correct that. Next time they'll do some other mistake, but they won't repeat the same mistake again. So whatever mistakes they have done in last 3 years, because of COVID, they printed a lot of money. They are going to correct it. So when this mistake has happened, markets are down. We should invest in those economies and take advantage into this. Correct. So the West made some mistakes, excess printing of money, then Ukraine-Russia crisis. All those things are going to get sorted out in next 6 months. If once they get sorted out, those economies are going to rebound. So nobody can replace Microsoft, nobody can replace Google, nobody can replace Netflix or Disney or Boeing. There are only two companies in the world which manufactures commercial aeroplanes, correct? And they have orders for next 5 years, 10 years, and India is going to be one of the big country who are going to buy from them. So those stocks are going to be rebounding, and we should use this opportunity to invest in them and protect your portfolio. This is a very good opportunity. So what is everyone thinking? If you're looking at news, there is a lot of negative news. Recession, inflation. There is going to be some political turmoil of this. There are some pension funds which are going to blow off, like what we saw in the news last week in UK. Anyone who's leveraged or did some wrong decisions is going to blow off, but that doesn't mean we don't have to use this opportunity to invest, correct? And that good thing is, if you follow a process and follow a strategy, you should be doing good. We should not be follow the bad news. And so if after every crisis a rally is there, so I'm expecting a rally. The other thing, if you look at this, there's an election in the first week of November, and it's called midterm election. 9 out of 10 years, in last 10 years, 9 times out of 10 elections, midterm, the markets always have gone down, and they rebound very sharply in the month of October. When we are in the month of October, if they don't rebound in October, they will rebound very sharply in November. So let's use this opportunity to buy US stocks, buy technology stocks, buy banking stocks. Interest rates goes up, those stocks do very well. So every crisis, so this just now I think it's market is oversold. Extreme bearishness and fear is there. So this is the time when you have to ask questions to ourselves. Let's look at the big picture of our life, follow the process, be logical, and be simple and humble, and keep investing and doing that. Your portfolio will do well. I think I'm coming to the end of today's webinar. I'm ready to take questions. As I said, asset allocation is the most important thing to manage volatility. So stick to your plan, stick to your asset allocation. You need to have a proper emergency fund, should be kept in banks only, should not be invested in stock market. 6 months expenses, 6 months. Any money which you require next 1 year or 2 years to buy a house or in business or education should not be invested. They should be kept in bank deposits. Only long-term money should be allocated, and they should be allocated in a proper ratio. And you should be fine, correct? Managing investment does not happen without these 4 pillars, correct? Strategy, vision, and time. Your thinking has to be very clear, simple thinking. Clear thinking will help you manage this volatility, and there shouldn't be a problem. But follow this, it should be good. And I think we are in the very close to the bottom of US markets, and we'll see a sharp rebound. Okay, we won't see that kind of sharp rebound in the Indian stock market. So if US markets rebound, whenever they rebound by 10-20%, India will rebound by 3 or 4% because India didn't fall that much. India didn't fall that much. Money will start, FFI money will start again flowing back to India. So first the large cap will rally and then the other sectors will rally. So that's going to happen. And I'm open for questions. And those who are watching this video for the first time or who have not subscribed to our channel, please subscribe to our channel. So whenever we want to reach you out and talk to you through this medium, it will be good. Yeah. Thank you very much. Thanks for your time. I hope you enjoyed the presentation and a disclaimer, correct? Mutual funds are subject to market risk and we are not promoting this service in the United States and Canada. Yeah. Please, let's see what questions I have. Yeah. One sec. Give me a second to read those questions. I don't see any questions so far. No questions? Samir, we don't have any questions here, is it? Okay, that's good. Okay, I see some questions coming. Kunal has asked a question. Do you think the talk about war is real and what sort of impact it would have on the market? Okay, so the talk about the war, correct? The war, what is the probability? You mean to say the war getting converted into a nuclear war, correct? That talk. Conventional war, which is already happening, the market has already factored that in. The nuclear war, if it happens, what is going to happen? Do you think any country is going to benefit out of it? Is Mr. Putin going to benefit out of it? I don't think so. And he knows that very well, correct? And whoever starts that war, both of them are going to get finished. So the chances of that happening is less than 2%. It's just a talk, correct? It's just a talk. Neither of the party will do that. The probability of that happening is very low. Yes, but I would say 2 or 3%, correct? Not more than that. Yeah, and so market will use this opportunity, market to rebound, correct? It's a other thing I'll tell you. There is a lot of destruction which has happened in Florida because of the hurricane last month. So whenever that kind of destruction happens, rebuilding has to happen. A lot of destruction is happening in Ukraine, correct? So the country is going to rebuild. So they will consume a lot of material. There is going to be a lot of demand, and so that helps the economy. So the conventional war always benefits the stock market, always benefits the financial market. And a lot of destruction is happening in America too, in Florida. A lot of properties got destroyed because of water and rain. So we'll see that benefit coming up. The second question is, can you help us relate the international and domestic situation in India's path for next 3 years, such as the impact on the investment, rising sectors and industries? Yeah, as I said, let's say you have a cricket team of 11 players, correct? And those 11 players, you have Indian stocks, sectors, correct? And you have one is US stocks, technology stocks, and all that. Now, that cricket team, every player does not perform in every match, but you, as a team, you continue with that, correct? So what happens? Certain sectors are going to perform very well. Certain sectors are not going to perform well. So the sectors which are not performing well, you invest in that. Now, which are the sectors which are not performing well today? The US market, the technology market, which are not performing. So if I have to put money today more, I'll top up my investments in those sectors there now. And the sectors which are performing very well, like infrastructure, FMCG sector in India. I'll just continue with my normal SIPs. I won't book profit. I'll just continue and building them. But if I have extra money, I'll pop up that in the sectors which are not doing well. So that's how you rebalance your portfolio, uh, and continue building that. Now, there are like many stocks in America, the dividend yield is 7%. On equity stocks, 7% dividend yield, which is very good. So the price wise, it's very good, correct? So you'll see that rebounding happening there. And in India, the three sectors which will do very good is long term. I'm talking about long term, not short term. Next month, I'm talking about 1 year, 2 year down the line. Is banking sector for sure. Information technology sector will go through some pain, but I'll invest. Without technology, nothing can happen. Do you think American companies are going to cut contracts on Indian technology companies? No. Because they'll know if they cut that tribal business knowledge of their company by the IT people is gone. So they can't afford to cut that. So yes, they may not get new contracts, but the existing contracts are going to continue. If you don't invest in IT, your business suffers. So Indian IT sector is going to do well. That is a sector which will bounce. Banking sector will be the first one to rebound. These two sectors I'll keep a watch and I'll invest that. Now next question is, if US rates crosses 4.5%, fixed income will be attractive than risk equity. Will there be big flow from outflow? Yes, very good question. This is a very good question. So when you get in a bond market a yield of 6-7%, yeah, currently FD interest rate in America is still 1%. If FD interest rates go by 3-4% up, money will flow out of the equity market and go. So why currently money is flowing out of emerging market and going to US? Because the US dollar is one of the most safest currencies in the world. So when US interest rates go up, money flows back to US and money flows back to the bond market there. Yes, money will flow. Now, as interest rates go up in India, if tomorrow India's fixed deposit interest rates go to 9% or 10%, money is going to flow out of the Indian equity and go to fixed deposit. Why should I take risk, correct? So that little bit rebalancing is going to happen, but that's going to happen gradually. The suddenness which has happened now of fall of the market, it's going to bounce back from here now. You'll see a bounce back, and we stick to your plan and build your. It will happen gradually, but that is a real possibility. Yes, it's going to happen. A couple of European banks on the verge of collapse, and these are much larger than Lehman. How do you view this risk and the effect if either or both should collapse? Okay, so today, if you look at the global, yes, some banks or some pension funds or some hedge fund is going to blow off. In every correction, every major global turmoil, like in India, UTI was in a problem in 1990s, correct? Unit 64 was in a problem, correct? So Lehman Brothers, US had happened. But today, US banks are very strong. Indian banks are strong. I think with this fear, many people have sold already, correct? A lot of derivatives have been unwound, and today there is a lot of short position in the market. I don't think we are going to get a correction like 2008, what happened that time. That time was the first time. This time, many people are prepared. And if someone blows up next week, I think that will be the bottom of the market. That will be the bottom of the market. I don't think markets will go down beyond that, because still people have a lot of cash. People have a lot of surplus money all over the world, including America. I don't think the average household is over leveraged. In 2008, the average household in America, India, Indian companies, everybody was over leveraged. That is not the case this time. And that kind of leverage is not there. So I think we should be okay. We should be okay. I don't, and that 40% fall is very sharp fall in last few months, and my natural instinct says that it will bounce. Now, markets are not going to run away. Markets are not going to run away. They are going to gradually recover. Correct. So there will be volatility. When the markets are down, take advantage of it. And if they go up, just continue normal investments. Don't put up more money. I would put it this way, and see what happens. Yeah. But I don't see a 2008 kind of corrections, correct? So if you look at this, COVID first time happened, there was a sharp correction. When COVID wave 2 came, the correction was not that severe. The world was prepared. COVID 3 wave came, the world was prepared, correct? Because it was not. So the credit crisis of 2008 is not going to repeat this time. Yeah. And that I'm very clear. That's not going to happen that much. Okay. Thanks for everyone's time. I appreciate it. And those who are going to watch this video later on our YouTube channel, please let us know if you have any questions. You can email us, and we'll be glad to answer those questions. Thank you very much, and have a nice weekend and good festive times. Thanks for watching this video, and thanks for your time. Thank you. Bye bye.